Alright guys, we're back again with another video, and in today's video I'm going to be overviewing high probability order blocks utilizing the Forever model, and I'm going to be doing a NASDAQ trade breakdown showing you guys multiple other examples with the same concept. Like always, you guys already know what we do from the beginning. We start off with a blank chart. I have NASDAQ on my left and the S&P 500 on my right. Now before I show my annotations, just mark up yours just to make sure that what I have on my next matches what you have on yours. I'm assuming that you got the annotations correct here. We have SMT divergence inside of our weekly internal range liquidity pool. We have step 1 and 2 of our model checked off of the list. And if you guys know that what we want to do if we're going long, we want to prioritize a long position in the stronger asset. So it will be NASDAQ making the higher low compared to ES making the lower low here. So now that we have step 1 and 2 marked off, what we do next is we go to our aligned time frame, the 4-hour chart, to then look for a reaction off of that key level and see if we can get an entry. So this is the 4-hour chart, and this is our weekly external range drawn liquidity and the tags of the weekly internal range liquidity pool. So when price runs this correlated low on the S&P 500 and we fail to run that correlated low on the NASDAQ, that is our first indication to then watch our intermediate term perspective, the 4-hour chart. And what we are paying attention to is this down close candle right here. And this is the last down close candle that runs liquidity and creates the higher time frame SMT. So what we're going to wait is the reaction off of that key level, and we're looking for a change in state of delivery to confirm this candle being a high probability bullish order block because it swept lows and it created our higher time frame SMT divergence. And you can see on the next slide on both the S&P and NASDAQ, and then the next candle closes above the body high, confirming our change in state of delivery, which will then be our POI for an entry point to go long to the external range target, but prioritizing it on the NASDAQ. And now that we have price giving our confirmation of the change in state of delivery, all we do is wait for price to come back down and tag that down close candle body high, and that would be our entry point. And what we would want to do is put our stop loss at the body low of the order block or the wick, depending on what your risk to reward can be set at. But whenever we execute off of these order blocks in price, what we do is we don't target the full TP of the external range liquidity pool. We target a 1 to 2. And once a 1 to 2 is reached, you take off 80% of the position and you leave 20% running to the external range targets. And after you take off the 80%, you adjust your stop loss to break even, and then the trade is completely risk-free from that point on. Fast forwarding a little bit, you could even see that even though price dug deep here, we just reached the mean threshold of the order block, still staying within the trade. And then the S&P 500 even came down and tagged that down close candle that swept liquidity and tagged the higher time frame key level. And you could see just how sensitive these candles are when it comes to executions. And this is literally all I do when I look for any of the trades that I take. These are where I'm executing my positions off of. I'm using the internal range liquidity pool as a reference point, and then I'm using the order block as an execution. And now, as easy as I laid it out, you can see all we needed to do was set our alerts at our stop loss, which was the order block low, and a 1 to 2, which was resting here at 18,947. And after we reached that 1 to 2, we had price smoothly deliver to the external range highs at 19,024, given the fact that NASDAQ was our stronger asset and ES was the weaker asset. You could see that this was reached before the S&P 500. Now that was just the step-by-step analysis of the NASDAQ trade breakdown and utilizing the order block of entry points. Now I'm going to show you a couple more examples as to why these candles are so sensitive in price delivery, just so that you guys can see a clear depiction. So what we have here is Euro AUD on the left and GBP AUD on the right. And you can see that price creates SMT on GA compared to EA, running a higher low and a lower low on EA. So this is priced inside of an internal range liquidity pool. We have one reference point and we have SMT inside of that POI. So we have step 1 and 2 marked off on our daily, and we drop to now our aligned time frame, and we go to the hourly chart to look for the reaction to see if we can catch a trade execution, just like how we did on NASDAQ. Now, just like we did on the NASDAQ, we're doing the same thing on GA because this is our stronger pair. So just like on NQ, we have short-term lows run here, and then this is the last down close candle that runs the short-term lows and creates the higher time frame SMT. So all I'm doing next is waiting for price to close above that body high and then give an entry point, retagging the body high of that order block. And that would be my execution for me to just look for a 1 to 2 risk to reward play en route to our external range liquidity pool draw. And I fast forward, the next candle confirms our change in state of delivery, and then the next candle after that tags the order block, and all I need to do is put my stop loss at the low or the wick or even the body, and then I target a 1 to 2 risk to reward, and you can see clearly how smooth of a delivery it is for us to just trade with these simple steps of a higher time frame key level tag, SMT divergence inside of that tag, and watching the reaction on the intermediate term perspective and utilizing those order blocks as our reference point to get into the trade. Now here's another example on EuroCAD and GBPCAD, but I still wouldn't have favored this one as much compared to the previous, primarily because of this aggressive sell-off that we had on the euro, but that just shows that euro pound was just so weak and we had such bullishness out of the pound. So what we were looking at is the same thing. We have price trading into a redelivery rebalance, creating SMT. I just want to show you guys what it looks like when price tags these order blocks and we create SMT on our higher time frame. So just like we had the example on the previous and on NASDAQ, this is what you want to focus on GBPCAD on the hourly chart. So you can see this is our SMT on our higher time frame, and then we have price sweep a short-term low. This is that last down close candle that sweeps liquidity, creates the higher time frame SMT, and then price will then wait for us to come back into that order block and then target a 1 to 2 like we did in the last 2 trades. And you fast forward price, just like I said and I showed you guys in the previous, look at how sensitive it is when price comes to that area in price. We tap it to literally the pip and we aggressively bounce off of that, moving to our 1 to 2 risk to reward target and then leaving our runner position to the external range draw liquidity. Here's another example. We have NZD JPY and AUD JPY on our weekly chart. We have SMT divergence on the lows on the weekly and SMT divergence inside of that weekly internal range liquidity pool, making the lower low on AUD JPY. So our focus is NZD JPY on our weekly. So we go to our 4-hour chart for the reaction on that aligned time frame. Just like the other trades, what are we looking for? We're looking for a sweep of liquidity, and then we're looking at that last down close candle that sweeps liquidity and creates the higher time frame SMT. Price closes above it, creating a change in state of delivery, and then what do? We wait, and price retraces all the way down into that down close candle, but it digs a little bit deeper into the down close candle resting here. But say you had your stop loss resting at the low run here, or you could have even done it at the wick low, and then the reaction off of that area in price is very sensitive. So you could have targeted a 1 to 2 from the low run here, or if your stop loss was resting here as well, to the external range draw and liquidity. Now what you guys are going to see moving forward is all of my trades are going to be stemmed from a higher time frame key level and internal range liquidity pool, but my executions are going to be based off of these order blocks. And this is what I have found to be the most sensitive area in price, providing the most volatility and speed off of my initial entry point. This has been my most favored execution, POI, for quite some time. But I hope you guys found all of these examples and the trade breakdown helpful, and you could hopefully take something from it and execute it live in time. But if you have any questions at all, or if you have any concerns, just drop it in the comments below, or any suggestions. But I hope you guys all enjoyed the video, and I will catch you guys all next week in the next upload.